Hello and welcome to Real Men of Real Estate. I'm your host today, Steve Matley, Coast to Coast Equities. Today we're going to talk about mortgages and funding, types of mortgages, what do credit scores mean, what about all those fees? To weigh in on that, we have experts with us today. We have sitting right next to me is Brian Fox of Fox Real Estate Group. Welcome, Brian.
Thank you.
Next to Brian, we have Tunde Ogunwole. He is a commercial development manager with Trammell Crow Company.
It's good to be here.
And in our guest seat today, we have Steve Tempel. Steve Tempel is a mortgage consultant with Vintage Mortgage Professionals. Welcome, Steve.
Thank you, Steve. Glad to be here.
So we're going to talk a little bit about funding and mortgage. And all of us have dealt with that. It's Steve's specific areas of expertise, but we all deal with that in our projects. And what I want to talk about is different types of mortgage and funding. There's all kinds of different things out there for different types of people looking for different types of properties. So, Steve, what are some of the types of mortgage we're looking at? We realize, okay, there's different things for seniors, there's things for military, there's things for multi-family, things for single family. What comes across your desk?
Well, we get quite a variety of clients that come in with different types of needs. And so there's a lot of different products, but they can be broken down into a few different categories. So first is what we call a conventional loan. And those are the loans that are underwritten to the Fannie Mae and Freddie Mac guidelines. And those are what typically people look to that have the best credit that come in for the best prices. And then there's government loans, and that could be an FHA loan, a VA loan for veterans, an active duty personnel, USDA loan. And then we could have people with other needs, such as they need special qualification loans, whereas maybe we can't qualify from looking at their bank statements when or their tax returns for being self-employed. So we're going to use a bank statement program. Or they have maybe some lower credit scores. We're going to use some alternate programs called Alt-A loans. So there's quite a variety out there. And of course, seniors have some special products available. First-time home buyers have some special products and down payment assistance programs. So we've got quite a bit to choose from now, whereas we didn't so much right after the crash.
And you mentioned early on the Fannie Mae, Freddie Mac, and we hear that kind of stuff around. I think a lot of people don't really understand what that is. It sounds like just the old couple that lives at the corner. But who are Fannie Mae and Freddie Mac, and why do they have so much to say about our mortgages?
So Fannie Mae and Freddie Mac are two separate institutions. So prior to the last real estate crash in 07 and 08, they were pretty much independent companies, traded stock. And then after the real estate crash, the government took over conservatorship of both of those entities. And so a very, very high percentage of loans are done to their underwriting standards. And the government has put in a plan, I think it was in 2010, stated they're going to put in a plan to get rid of those entities. And it's looking to the point to where now it's a very profitable situation. Don't think they're going to go away. And they're really good entities to be in place. Outside of that, there's a lot of private investors. But then it comes in with a lot of different underwriting guidelines and very complex. And it's still to the point to where the loans that are sold to Fannie Mae and Freddie Mac, no one individual pays Fannie and Freddie directly, okay? So they don't know necessarily that their loan is held with Fannie or Freddie, but that's still the best opportunity for people to get the lowest rate and the best product today if they've got good credit.
Okay, and Brian, you're a real estate agent. You deal with a lot of the residential side, so this is close to home to you.
Sure.
How does this type of mortgage? How do you work with your clients? How does this work?
Well, okay, so me specifically, I have a bit of a different background. As Steve and I were talking earlier, actually was in mortgage and banking before real estate, which was the best prerequisite education I could ever receive, because in our business, 90% of it goes bad in the money. It's always the money. It's either credit in the money or down payment in the money, debt wasn't, it's somewhere in the money, typically. So for me personally, most people do get Fannie Mae and Freddie Mac loans because that's just the majority of what's out there. Most people are employed, therefore they have typical down payments, typical credit, typical lifestyles. So it makes sense just throw them in that bucket. However, a lot of my clients, they do own their own companies. Some are very high net worth people, and for them, their money is based more they write a lot of it off, or they get a very specific type of salary from their company, but they own a majority of it, so they can't qualify for Fannie Mae and Freddie Mac stuff because it's just too scrutinized. So they have to do a bank statement loan. Typically, it's based on their business, and they go only based on deposits. So if anybody's listening to this and they are one of those kind of companies, it's a great program because the rates are fairly competitive what super jumbo rates are, but there is almost no red tape in the program, and Steve can probably talk about that some more, but those have been great for me.
Okay, and Tunde, you're in a little bit different area. You're doing commercial development. So how does the mortgage markets affect what you're doing?
Yeah, it's a great question. A lot of the projects that I interact with on the P3 or public-private partnership to do ground-up development or redevelopment for public agencies, we typically see that those agencies are scored by a couple different entities, Moody's, Fitch, or S&P, and that really establishes the credit worthiness of those agencies to issue bond financing for some of the development deals. So that's a very different slice of looking at the lending environment as it relates to development deals, which I think is pretty interesting and exciting, and it really does give you a good perspective. If agency has double B or lower, then they're outside of the investment grade, and so the interest rates associated with those bonds are significantly higher than the AAA financing.
I think a lot of people don't understand that the public bonds are essentially a mortgage held by the general public for public works. So when you vote for a bond measure, you're sliding the credit card of the government agency, and you're now on the hook to pay that back. I think a lot of people think that's free money you get at the polls, but it's not really. So that's a very important thing you brought up there, Tunde, how that works. Steve, I want to talk a little bit about when people come into your office, and how do you navigate this minefield of the different ways they can go on these mortgages?
Well, first of all, is we sit down and interview them and find out what are they planning to do, what's their desire, what's their needs, what's their long-term goals, and that often gets missed a lot of times when somebody's seeking a mortgage. We definitely want to ask them those questions. So what we do today puts them in the best position for their long-term plan. So once we find out what their needs are and their desires, and then we drill down on their application, learn about their employment, their credit, and then from there we can develop a plan and find what's going to be best for them. So for example, if somebody comes in and they've had, let's just say they've had a foreclosure and it's only been 4 years, automatically excludes you from the Fannie and Freddie products. Okay, so then we need to look at other products. FHA is a good example that we can go. So that's where we start.
Okay, and so Brian, when clients come to you, have they been to someone like Steve first, or are you introducing them to someone like Steve?
It could be a combination of both, and typically I do interview the mortgage person, so that's just a quick note. I talk to that person first, make sure he knows at least as much as I know, and that could be enough. And then I say, okay, he can take it from there, but if he's good, I'll let him have it, otherwise I go to one of my guys.
Okay, great. So we're going to take a break right now. We'll be right back. This is Real Men in Real Estate. When we come back, we're going to talk about credit scores and how to qualify for a loan.
Hey guys, how are you today?
Good.
I'm here to talk about how with technology you can make amazing worlds. Come with me. My team and I groomed the Halo world to life.
Is that you?
That is me. I wasn't a math genius and I knew nothing about coding. But you guys do. You guys have the power to change things.
I want your job.
I want you to have my job.
Opioid dependence can happen after just 5 days. Know the truth, spread the truth.
Welcome back to Real Men in Real Estate. I'm your host, Steve Matley. Today, we have Brian Fox, we have Tunde Ogunwole, and we have Steve Tempel with us today. And we're discussing mortgages and funding for real estate projects. So when we talk about funding and qualifying for this, there's this thing out there called the credit score. Who controls it? Where does it come from? What does it mean? How do we get our minds around it? It seems to be the most important thing in the world and nobody really understands it. So I'm going to start with you, Steve, but I want everybody to kind of chime in. What is this credit score thing?
So it's interesting. People come into me and they say, well, we should have no problems qualifying for a loan. I ask, well, why is that? Oh, we just bought a car. Well, that really means nothing. And by the way, you just bought a car, so you probably qualify for a little less now. Mm-hmm. Okay, you should have probably come to us first so we could talk about your plans and structure that. But so credit score, then I ask them, well, what is your credit score? Do you know? And most people would say, yeah, it's X or it's Y. But I always have to ask, how is it that you know that? Anybody know why I'm asking that question?
Because they go on those public sites that says what yours is, or it's attached to their credit card.
Yeah, and why is that a problem?
Because it pulls one bureau and it's a snapshot.
and because it's pulling using a different scoring model. So my knowledge is that there's at least 12 different scoring models that are used. So we use the mortgage model. So unless you're getting your credit score from someone who's in the mortgage industry using that model, we don't know exactly what your score will be with us. You go to
So Steve, you're saying that if you go to the bank and they pulled your score for a car loan, I can't trust that for a mortgage, or if I go on one of those free website deals, I can't trust that score.
Exactly. You're going to a car dealership, you're definitely going to get a different credit score because the algorithms are set for them. Our algorithms are set for the mortgage model to look at things and weigh things a little differently. Okay, so I'm always asking that question. Now, they go to some of the free sites. If the score range is from 350 to 850, then I can say, okay, then you're probably within a 20-point spread, probably, okay? But there are credit scores out there that are in a different range from 500 to 1,000.
Fascinating.
So if you had a 750 credit score in that range, I'd say that's great on our model. But on that one, no, that's not so good. So that's why we always have to ask.
So Steve, that's fascinating. What are some of the tranches of a excellent score down to a good score and maybe not so good score? What do those ranges look like?
So since our range goes all the way up to an 850, typically anything 740 and above, if we're talking Fannie, Freddie, you get the best rates, okay? If you're doing jumbo loans, and usually there's a 760 category and above gets you the best typically, okay? But if you're from 700 to 740, you're going to get an excellent interest rate on a conventional loan. Once you go below 740, it starts to hit you quite a bit, and below 660, it really hits you hard, all the way to the minimum credit score that Fannie and Freddie will do is 620. If you're down at 640, 620, you better plan on an interest rate that's going to be at least 0.5% higher, maybe 0.75% higher than what you would get if you had a 740 credit score.
Okay, now, is this credit score the almighty pill? I take this as the one magic bullet I bring in and I get what I want, or is there's nothing else they're looking at, right? I got my credit score, I'm good, right?
And that's the perception that most people have. They say, well, this is my credit score, that should be all you need. And that's only one piece of the puzzle, because there's so much information on the credit report. We're going to look at it all. There's a lot of important factors there, because you might have a 720 credit score, but you might have some derogatories on there. You might have some judgments. Those are going to be some issues. You might have a bankruptcy. There's some other things on there, so we need to look at the whole
Brian,
picture.
have you had some clients that were shocked by, were surprised by what happened?
Yeah, a lot of them. Actually, I was going to ask you a question on that exact topic. So what is the dollar value difference between score to score, like in the form of mortgage? So like, for instance, if I have a $300,000 deal and I'm at one level of scoring and I'm inside that bucket and I'm in a different bucket, I really want people to get this because I have to have this conversation a lot. What is the value difference between those two payments? Because that's a big difference in what they purchase.
Well, exactly. So if you're 0.5% higher in interest rate at $300,000 than you could have been, your payment's going to be this much lower here. Dollar to dollar, I'd have to run the calculations to see exactly, but it could be significant. It could be like $150, it could be $200 a month difference in payment. Now, another important thing, if you're putting less than 20% down, you have mortgage insurance, then it affects that payment as well. Mortgage insurance is very sensitive to your credit score, so it could be several $100s higher of a payment
Or
then.
thousands.
Exactly.
Crazy.
Okay, now we start lumping in things like property taxes and tax impounds and those type of things. Is that all factored into that mortgage and what they can buy and all those type of things?
So exactly. So when we're looking at what their monthly obligations are on the home, we're not just looking at the principal and interest portion of their payment. We're also looking at how much is their insurance, their homeowner's insurance. And that doesn't vary too much typically, but taxes can vary greatly. I mean, it can be like as low as 1% all the way up to, I've seen some as high as 2.4% in my local area and some new build.
Because of those community facilities districts that tack on top of it,
Exactly.
right?
You've got
Those bond
special-
measures that
Yep.
Tunde was talking about, those get tacked on top of your property taxes.
Yes, often referred to as Melleroos
Melleroos,
or
right.
special assessments.
I had a position one time as the VP of a home builder. I was in charge of acquisition and planning, and that's what I did, was form HOAs and CFDs. I was the guy putting, and sometimes there would be 12 to 14 different bond liens on these properties that would go in, because every public agency, the school district, the flood control district, the parks and recreation district, everybody wanted something in there to add on to it. And you're right, it taxed on each one's adding another 0.4%, 0.3%, and you end up with sometimes almost up to 3% on some of these things.
And Steve, with your experience, why don't you address the term of those bonds? Because the good news is a lot of those fees will reduce in the future, right?
But they could also go up. Some of them actually have mechanisms in there where the agency in a public hearing can vote to increase that bond. Some of them are latent, and so they're in there and you're not paying anything. 5 years from now, they have a meeting of the flood control district and boom, you just got popped for it. And now you've got to pay that in because that was already approved. Well, who approved it? The property owners. Who was the property owners of the neighborhood? The builder. When they put it in. And why did they do it? Because they couldn't get the approval to build those homes unless they put that in, because that the public agency says you can't build unless you put these on top of these homes. A lot of the reason why real estate is so expensive in California. There's a pressure point because of the high demand, but also there's a lot of these fees and taxes that go into this.
Steve, I got a couple questions. Just walking in the door, what are some of the things that people should come to you prepared to answer?
If they're coming in to get pre-approved for a loan or just to see what they qualify for, a lot of it we can just talk about over the phone and do what's called a pre-qualification, where we don't review any of the paperwork. But if you really want to put an offer in a house, we're going to need to have your tax returns, your pay stubs, your W-2s, your bank statements, and then we'll pull up the credit so we can verify everything. We're going to verify everything just like an underwriter would, so when you go to put an offer in, that you know that things are going to go through on that offer. You're not going to get out there and spend money on appraisal and home inspections and have it fall apart at the last minute. It's the worst fear of a real estate agent, right?
The good news is I have a bit of the education up front, but yes, for the majority of people I work with, that is their worst fear.
So now what do we do to influence this credit score and make ourselves put in a better position so that when we come to you, we get a better interest rate, we have a better chance of qualifying for the loan, and we can buy more house?
So the good news is there's some pretty reputable websites out there that you can subscribe to that'll give you guidance and tips on what to do, okay? The worst thing you can do is try to do it on your own without some expertise. I really highly recommend that they get with a really good, reputable mortgage consultant, okay? Someone like a certified mortgage planning specialist, somebody that's been doing this for a while, that knows how credit works, to be able to guide them along the way. Because I've had people come into me and they say, hey, you know, we knew we were coming in to meet with you. So a week ago, we went ahead and we paid off all our collections. Well, it's sort of odd in thought of how things should work. But if you go and pay off all your collections, it could seriously decrease your credit scores. Yeah. Because collections will hurt you the most based on how recently it's been reported on your credit. So you have to be very careful on things like that.
So it's a little bit counterintuitive, isn't it? Exactly. I walk in and I'm debt-free and I qualify for less than when I still owed a lot of money.
Exactly.
So been a good discussion on that. We're going to take a short break. And when we come back, we're going to talk about that mysterious world of fees that go with mortgages and funding. Don't go away. This is Real Men in Real Estate. We'll be right back.
Put the keys down, Kevin.
But I'm gonna drive home.
There are several warning signs present that you shouldn't be driving.
My text to emoji ratio has gotten a little out of hand.
A little?
Yep, I'm definitely gonna call a ride home.
First time I tried Vicodin, and it was laying around my mom's house. I didn't know they'd be this addictive. I didn't know how far I'd go to get more. Opioid dependence can happen after just 5 days. Know the truth, spread the truth.
Welcome back to Real Men in Real Estate. Today we're talking about mortgages and funding for real estate projects. And what I want to get into is that mysterious world of fees. You know, there's an old saying that two things you don't want to ask about how they're made, and that's laws and sausages. And I'm thinking mortgage fees might be the same kind of thing. What's all in this stuff? So who can help me out on what creates this fee structure for mortgages?
Well, there's always fees involved. Sometimes people come back to me and they say, well, so-and-so offered to do a refinance, no fees at all. Well, the fees are just there. It's just, it's done a little differently. For example, people often know the term how you can buy down the interest rate. Well, the reverse is true too. You buy up the interest rate. So what they're doing is they're simply going with a little higher interest rate to get a credit from the investor, Fannie Mae or Freddie Mac or whoever it is, to cover those fees. Because you're always still going to have escrow fees, title fees. You're going to have the recording fees at the county. So they're all going to be there. The neat thing today in today's environment, the government has our industry highly regulated now, becomes a little bit more transparent. It's good that in the initial process, a client is going to get a loan estimate. And in that loan estimate, there are certain fees that cannot change at the end. And there are certain fees that can only change by a certain tolerance, say 10% on title and escrow fees. And so that's really good because the client up front knows in the end there's not going to be any big surprises like there might have been in the old days.
Okay.
Well, I'll just say for me personally, what I was in mortgage before we talked about, but the thing for me is that the fee structure when I was in the business, I mean, it could change on a daily basis. You know, now they've set it to a point where, correct me if I'm wrong, the loan originator, the officer, has to preset the fees with Fannie Mae and Freddie Mac. Is it 90 days in advance, a month in advance? What is the date? How long in advance do you have to preset your fees for all the loans you do subsequent to that?
So what you're referring to is loan officer compensation.
Yes, that.
So loan officer compensation is now on a set schedule. So it's based on the size of the loan, but it's on a set percentage. So a loan officer just can't change it and say, oh, I'm going to charge more for this client. But the downside is they can't say that, well, this is a really good client or that's a big loan and it's easy, great credit, that I'm going to cut my fees to give them a better deal. So it sort of works both ways, but the good news is they can't jack things up. Right. And so it's preset for a period of time. Now, the CFPB, regulatory board, has not defined the exact term. So a lot of companies say you can only change it once every 30 days. Most lenders now are going to once every 90 days before you can make any adjustments if you wanted to.
Okay, and Tunde, on your projects, I know you guys end up doing takeout loans when you get to the end of construction. Do you guys have to deal a lot with the fees, or is that set based on the kind of loans you're doing?
Different ways that fees impact us. We talked a little bit about construction loans, and then when you're done, upon completion of construction, you can have a permanent loan that takes out the initial construction loan. And then the other ways that we experience fees are in development. You have the developer fees, development impact fees, the school fees, plan check, fire, water, sewer.
It's quite the laundry list. Yes.
It's quite a long laundry list, and it's not always fully understood when you're going into the development process. So those are other ways that you experience fees that are part of the development process.
Right, which of course becomes part of the end cost of the produced real estate, whatever the building we're putting on there. I think a lot of people don't understand how much of that is built into what they're purchasing. So it's not all just the sticks and bricks. This is Real Men of Real Estate. Today we've been talking about mortgages and funding and credit scores and the whole world of how we fund our real estate projects. I want to thank all the guests today. Brian Fox with Fox Real Estate Group, Tunde Ogunwole with Commercial Development Manager for Trammell Crow Company, and of course Steve Tempel, who is our mortgage expert today with Vintage Mortgage Professionals. Make sure you tune in each and every week to Real Men of Real Estate and learn different things about the real estate profession, real estate industry, legal, business structure. We cover it all. EAN TV on Roku and Amazon Fire. Don't miss an episode. You'll be smarter because you did. This is Steve Matley, your host with Coast to Coast Equities, and we'll see you next week.